War was not the most dangerous option facing Europe's great powers. Default was. The assassination in Sarajevo did not create instability. It arrived inside a system already stretched to its limit. Archduke Franz Ferdinand fell, alliances activated, and millions would soon vanish into mud and wire. But those events unfolded on top of balance sheets that were already leveraged beyond safe reversal. Before the first shot was fired, sovereign liabilities had been layered across London, Paris, Berlin, and New York. Banks extended credit lines measured in billions in today's terms, embedding exposure across rival empires and tying adversaries together through shared financial risk. When that money moved, contraction stopped being neutral. Withdrawal meant default. Default meant exclusion from the very credit networks that kept imperial administrations functioning. By the time the crisis escalated, governments were no longer choosing between peace and war. They were choosing between recognizing losses immediately or extending the structure long enough to postpone collapse. Rewind to 1914, and the surface narrative still looks familiar. Europe is a powder keg as nationalism surges, militaries mobilize, and the assassination lights the fuse. But beneath the speeches and mobilization timetables, another contest had been building for decades: financial, cumulative, and increasingly rigid. Empires had expanded on borrowed capital. Gold convertibility restricted adjustment, and secret treaties aligned not only armies but obligations. By the time diplomats discussed de-escalation, delay already carried balance sheet consequences that could not be absorbed quietly. Picture Britain and France, the old guard, perched on massive colonial holdings in Africa and Asia. Rubber, oil, cotton, gold, raw materials flow inward to feed factories that never sleep. But those empires are leveraged to the hilt. Endless imperial adventures have piled debt upon debt, obligations rolled forward rather than cleared. Germany, the late-arriving industrial powerhouse, scrambles for scraps in Morocco and the Middle East to keep its steel mills fed. Russia and Austria-Hungary, vast and brittle, borrow simply to keep their multi-ethnic empires from tearing apart. And behind them all, the strings are pulled not by kings or kaisers, but by merchant banks in the City of London and on Wall Street. Rothschilds, Barings, Morgans. Lending at rates that reward risk and punish retreat. By the time 1914 arrives, the creditors are no longer observers, and the space to step back shrinks to whatever the lenders will tolerate before refinancing closes. With the creditors no longer on the sidelines, the global economy sits bound to the gold standard, a rigid system where every currency is backed by bullion at fixed rates. One hiccup in trade, one tariff, one blockade, and gold drains out like blood from a wound. Imperial rivalries are not about pride alone, they are liquidity events. When Britain blocks German ships in the North Sea, it isn't a naval gesture, it's a balance of payments shock. Berlin's exports collapse, and its banks lose reserves. These financial feuds don't just make war more likely, they make it fundable. From J.P. Morgan's $500 million lifeline to the Allies, to Germany's frantic gold seizures from its own partners, money doesn't follow the war, it leads it. Once that financing exists, stopping becomes harder than continuing, because the exposure is distributed, and no single actor can absorb the unwind without systemic strain. Because the losses can't be contained once the money moves, the story has to start at the root. Imperialism isn't a noble quest for glory, it's a revenue strategy. By the late 19th century, Europe's great powers have carved Africa like a holiday feast. Britain takes Egypt and South Africa for cotton and gold, and France digs into China for rubber. Germany elbows in late with Tanganyika and Namibia for phosphates. Factories belch smoke day and night, turning out rails and rifles, but profits depend on cheap inputs. Colonies promise controlled labor, captive markets, and raw materials shipped home to Manchester or Berlin. Yet building these empires costs fortunes. Railways through jungles, forts in deserts, wars against people who resist conquest. Governments pay by borrowing heavily from private banks, trading future tax streams for present survival. Once future tax streams are pledged, Britain, the empire where the sun never sets, owes billions in bonds by 1900, much of it to a handful of financial titans. Rothschild networks span Paris to Vienna. Barings, fresh from an Argentine debt scare, are cautious but present. J.P. Morgan watches from across the Atlantic, Europe's appetite growing. These are not public loans debated in parliaments. They are structured obligations collateralized by projected colonial revenue. France's push in North Africa leaves Paris bankers engineering arrangements that turn empires into automated payment channels for lenders. Germany feels the squeeze most sharply. Unified only in 1871, it plays catch-up, its navy budget swelling while colonies like Togo barely pay for themselves. By 1913, Berlin's external debt reaches staggering levels, funneled through the Reichsbank and private houses. In Russia, Tsar Nicholas borrows billions from French banks to arm against the Ottomans, tying St. Petersburg's fiscal stability to Parisian credit markets. At that point, choice thins. Default means collapse. Once collapse becomes the alternative, negotiation stops being a real exit because any concession risks triggering creditor retreat. With negotiation no longer a real exit, this debt pyramid begins to wobble. Tariffs spike and trade wars flare. Britain's isolation strategy squeezes German exports, crashing Berlin's gold reserves. One failed harvest in the colonies, one uprising in India, and the system edges toward default. These pressures aren't side notes, they alter policy. Kaiser Wilhelm II isn't just concerned about encirclement. He's confronting a narrowing fiscal corridor if Britain restricts access to colonial revenue. And the banks profit from the tension. More risk brings more loans and higher interest. By 1914, Europe's economy resembles a house of cards, each monarch holding mortgages from the same lenders. At that point, restraint costs more than escalation, because restraint forces immediate recognition of debts that escalation allows to be rolled forward. Because restraint forces losses into the present, the mechanism that turns rivalry into inevitability is the gold standard itself. Since the 1870s, major powers pegged their currencies to gold: pounds, marks, francs, all redeemable for fixed amounts of metal. It smooths trade and stabilizes prices until stress arrives. Gold is finite. Wars, famines, strikes, anything that disrupts trade or mining sends bullion fleeing. Britain hoards a massive share of the world's gold through colonial pipelines from South Africa and Australia. Germany scrapes by, its vaults thinned by naval expansion. When crises like the 1911 Agadir showdown over Morocco erupt, gold drains across borders. Banks jack up rates to lure it back, strangling credit. A Berlin baker can't get a loan because the Kaiser's fleet drained reserves. Unemployment spikes and bread riots simmer. The only apparent fix is more colonies, more mines, more gold. But colonies are zero-sum, and every grab tightens someone else's throat, eliminating neutral space where losses can dissipate without reprisal. With no neutral ground left to absorb losses, secrecy compounds the lock-in. Alliances aren't handshakes. They're IOUs sealed in classified envelopes. Bismarck's reinsurance treaty promises Russian neutrality under specific conditions, hidden to avoid spooking Austria. Later, the 1915 Treaty of London bribes Italy with slices of Austria and Albania to switch sides, complete with a secret loan and promises of spoils. Sykes-Picot quietly carves Ottoman lands to pre-divide oil fields after victory. This isn't diplomacy. It's capital allocation for conflict, with banks underwriting the bonds. Germany, boxed out, turns inward, lending heavily to Austria-Hungary, eventually holding most of its debt and draining its gold. Berlin bankrolls Vienna's war while siphoning bullion to patch its own holes. Once Vienna's finances are entangled this deeply, stepping away from Berlin becomes financially impossible without immediate insolvency. Millions march toward death, but clerks in Frankfurt adjust the margins. Because stepping away becomes financially impossible once the debt is held, the structure twists again. A single American banker steps in with a loan so large it doesn't just fund a war, it forces a neutral giant to choose. J.P. Morgan Jr., the Wall Street colossus, turns neutrality into arithmetic. When fighting erupts in 1914, America is supposed to sit it out. Wilson speaks of peace, the public shrugs, and Morgan sees exposure. From the first days, his firm becomes the Allies' exclusive buyer, billions in munitions, food, and steel flowing through his books. In 1915, a $500 million loan to Britain and France sets a record. Rothschild channels help wire funds to keep Paris afloat. The calculation is straightforward. A German victory means default. Once those bonds spread through U.S. markets, detachment becomes dangerous, because reversing course would require absorbing losses already embedded in domestic financial institutions. With losses already distributed across domestic banks, by 1916, Britain is bankrolling allies outright. Italy's bills pile up, and two-thirds of French and Russian gold reserves vanish. Overseas assets are pawned, and private credit is exhausted. Morgan leans on Wilson, arguing that Allied collapse would hit American exports and banking stability. Congressional inquiries later expose the exposure. Billions at stake. Default equals domestic contraction. In 1917, American troops ship out, not only for democracy, but to stabilize a financial position already committed. Germany counters with desperate deals. Gold shipments from Ottoman lands, billions in credit to Austria, but the strain snaps back. Reichsbank notes triple and inflation looms. Central banks, newly empowered institutions like the Federal Reserve, suspend gold convertibility and print freely. The rules dissolve and debt monetization replaces restraint. Once chosen, there's no clean way back, because restoring convertibility would require reserves that have already been spent. With convertibility gone and reserves exhausted, the war's price climbs into the tens of billions. Taxes cover little, and bonds fill the gap, sold on patriotism to families and pensioners. Commissions flow to Morgan and Rothschild houses, while trenches fill with the poor. Letters from the front speak of mud and loss. Boardrooms toast victory loans as 16 million die. Empires collapse, yet the financial web holds. The United States emerges as creditor king, London dethroned but still maneuvering. This outcome isn't accidental, it's designed. Once creditor dominance shifts across the Atlantic, Europe cannot refinance without American consent. With refinancing now dependent on the new creditor, when the guns fall silent in 1918, the books don't balance. They break the world, and Versailles doesn't bring peace. It reloads the trap. Reparations chain Germany to obligations it can't meet, feeding hyperinflation and the resentments that follow. Once those reparations are fixed in treaty form, reducing them means unraveling the entire settlement, a step none of the victors can afford. The Sarajevo bullet becomes the accepted spark, but the real battle was fought in vaults where gold outweighed glory and loans outlasted lives. We romanticize trenches, but the deeper horror is quieter. Ordinary people, your great-grandfather in the mud, sacrificed to spreadsheets. The war to end all wars mints modern finance. Rothschilds and Morgans never fire shots, but their ink redraws maps of misery. And if you think this is safely sealed in the past, that assumption doesn't survive contact. The mechanisms persist. Sanctions, bailouts, debt crises, they echo the same leverage and constraint. Names change, currencies float, architecture remains. History doesn't end with an armistice. It's underwritten.